Okay, well, I think what we'll do is we will get started because we're at, well, now I can't see my clock, but probably 11:05. Yeah. So welcome, everyone. My name is Christy Luzar. I'm the Executive Director at the Urban Economic Development Association, or UEDA. And we are hosting this webinar as part of our Take Root Milwaukee program. And so I'm going to actually ask, well, actually, wait, we'll go to the next slide and then we'll do some introductions. So some webinar logistics. Here are our speakers for today. Kindly stay muted, use speaker view if that's easier for you. Put any questions in the chat, and we'll answer as many as we can throughout the presentation. We do have a lot of data. This is the third one that we have done in the last year. In fact, the first one was on December 3rd of 2020. So it's like we're exactly a year later. But we'll try to answer as many as we can and know that this is a series. So whatever we talk about, whatever questions come up, we sort of take that back and think about what could we do for the next one and kind of keep this information learning going. So please do that. And then we will share the recording and the slides. And so now I'm going to ask my two co-presenters to introduce themselves real quick. Lamont, if you want to start.
Hi, I'm Lamont Davis, the Executive Director of the Milwaukee Community Land Trust.
Hi, I'm Bethany Sanchez. I direct the Fair Lending Program at the Metropolitan Milwaukee Fair Housing Council. And both Lamont and I co-chair the Education and Advocacy Work Group of Take Root Milwaukee. And we're founding members of Take Root Milwaukee.
Yes, well, thank you both. So today we are going to present the data. So this is something that actually Take Root has done for many years, but the last year we've sort of really thought about how we can deepen the way that we look at the information. So we'll be looking at the racial and economic disparities related to homeownership and then mortgage lending activity. And so we'll continue to try to unpack these issues in different ways and then talk about strategies moving forward. Okay, so who we are, we have a little bit of information about Take Root Milwaukee if you're not familiar. This is a consortium that has been around since 2010 that formed after the foreclosure crisis. And so this group of really committed and amazing individuals and groups has been working together around homeownership issues in the city. And as Bethany indicated, her and Lamont have been founding members. We have lots of great folks who have been involved the entire 10 years and then some. And then we have actually partnered as part of the Milwaukee Civic Response Team. There's an economic recovery group that formed in 2020. And one of their pillars, if you will, is around homeownership stability, particularly for African-American and Hispanic homeowners. And so what can we do to ensure that we do not see the same losses in homeownership that we saw in the aftermath of the Great Recession. And so we really tried to take what we do through Take Root and sort of support the interests of that group. And Bethany and I both sit on that and sort of, we have this great vehicle of Take Root that we can use to sort of advance some of those things. I don't know if Bethany and Lamont, if you wanted to say anything else about that.
No, I think you covered it.
Okay. Right. So Bethany, if you want to talk a little bit more about HMDA data.
Sure. So HMDA is it's the shorthand for the Home Mortgage Disclosure Act, which was a law that was enacted in 1975. And it's gone through different incarnations of how it's regulated and which financial institutions need to provide the information and how that information gets distributed since then. But and also since 2018, there have been a number of additional categories of information that the institutions need to provide to the regulators. So the information goes to the FFIEC and the Consumer Financial Protection Bureau, and the regulators are basically any lender, whether it's a bank or a credit union or a mortgage company, or I don't know if there would be another category besides those, but any home lender that provides that originates at least 100 loans during a calendar year and then does it over a 3-year period. So The data really helps us show who's serving the housing needs of the people that we serve. It gives advocates and people on the ground really helpful information, as well as, typically we share that then with public officials, helping them to develop policies and showing them what's going on and who's getting loans and who's not. And of course, as showing lending patterns that could be discriminatory. And there's a lot of concern about that, and rightfully so. And that's a big issue. So since 2012, we've compiled this annual analysis of HMDA data and share it with our members. And the series really is, as Christy said earlier, an interactive, iterative kind of series that helps us inform our response to what's going on the ground in Milwaukee, the city of Milwaukee and Milwaukee County.
Great, thank you, Bethany. So what kind of data do we have other than HMDA data? So we have economic data by race and ethnicity. The HMDA data that Bethany just talked about, we get that information via a lending patterns database reports that Bethany is able to run and the Fair Housing Council subscribes to. And they're really great. And we'll talk a little bit more, you'll see some of that, but these are things that she can continue to do with a lot of members. So if you're interested in different kinds of information, specific lenders, that kind of a thing, please reach out to her. And then we have, what we really try to do is look at the top 30 lenders every year, like who is lending, what kind of loan purpose, like what do the numbers look like, how are they reaching traditionally what we think of as underserved borrowers and areas, so non-white borrowers and LMI borrowers and tracts. And then we compare our group of Take Root Milwaukee lenders, so those that are active with Take Root versus all lenders, just to sort of see if basically our hypothesis a long time ago is that those that are involved with Take Root Milwaukee would likely have a stronger eye towards serving these underserved areas and people. And so by their participation in Take Root, we would anticipate that they would do better at serving these markets. And every year that is actually borne out to be true. So Lamont, I don't know if you want to add anything about this, sort of from your perspective.
Yeah, I think what we want to achieve as well is we want to be supportive more than anything to our partners. Take Root has an extraordinary partnership of lenders, realtors, bankers, nonprofit groups, housing rehab groups. And so we get a chance to be informative. We tell people about what's going on in the market, what does it look like, and sharing that information between all of those actors has a benefit for each and every member of Take Root. Of course, you always have to look for what has changed from year to year. And we've seen some striking changes. A lot of this is probably relative to the new housing boom that we're in. But we want to be able to see what goes on year to year so we can monitor and adjust our services. Why would we want to do that? Let's hold our lenders accountable. Let's be supportive of our lenders. We should be looking for positive trends and negative indicators. Take Root is set up to be proactive and not reactive, even though sometimes we have to be reactive. But that's why we do this work every year, so that we can have a firm grasp of what happened and create new strategies to support and strengthen our work of our partner members.
Yeah, thanks, Lamont. You bring up a great point. I mean, that was really one of the reasons why Take Root was formed in the aftermath of that crisis, that you would have this group of people that are active in homeownership and sort of trying to look ahead, look out into the market and see what is changing and what can we do, not just both to be reactive, but maybe a little bit more proactive in our response. And so that's why the lending data actually helps give us a really good slice of what's happening. And I just realized I would be remiss if I did not thank our other 3 Take Root members who help us put together these series. But I do want to acknowledge Bill Kopka from Associated Bank, Irma Yepes-Klassen from Zilber Family Foundation, and Maria Prioletta from the Department of City Development, who are very active in Take Root and sort of help us put together these webinars and these series and review what we're doing. So shout outs to them. If I didn't do it now, I'd forget again. So, we can't be reliant on my sad memory right now. Okay, so our framework for today, one of the things that we came across in the last month or two is, there's a lot of really great research that's happening right now around homeownership disparities and the racial and economic disparities that we see. And so this blog was posted in October of this year by the Urban Institute. And so we did send out a link in our reminder on Monday, but we will include that too, and it's linked in the slides. But it really gets at these, a lot of what we see as a result of homeownership gaps are also systemic racism practices that were embedded in our credit and mortgage underwriting practices over the decades. And so when you look at that, you sort of get a sense of, what are the underlying causes that maybe are driving these disparities? And we'll go through some of that data. But the blog really points out that the gap is really the same as it was in 1960. And when you think about 1960, I've heard this a few times, and I think Bethany knows that is before any of the fair housing legislation was enacted. So that's actually a really depressing point of reference to think about.
It really is.
Yeah. And so what we do see is that applicants of color continue to experience higher mortgage delinquency rates or denial rates, I mean. And this actually we really looked at in our October 8th webinar, where we looked at some HMDA data reports, the disparity profiles that really show that. And that we saw credit indicators are really one of the main reasons for those denials. And that is also pointed out in this blog. And so our mortgage underwriting standards also wrestle with these issues and this legacy of systemic racism. The blog is really great. It's not long, so I highly recommend you check it out. And I borrowed very heavily for these slides. So I'm acknowledging the fact that we are, kind of building off of that really great work. But
it's not, sorry.
Yeah, sorry, go ahead.
I was just going to say it's not news to most people, but it's helpful to have this framework and really look at these 3 C's: the credit and collateral and capacity. When you see that communities of color were denied access to services that help them to build their credit, well, then it's not going to be a surprise that there are credit challenges. And they'll be less likely to meet the lender's standards in terms of purchasing a house or getting a loan to fix up their house. Also, on the collateral side, the second bullet point, collateral primarily refers to loan to value issues. So there's not enough collateral, the value of the property, to support the loan. And so if there's, if that doesn't work, fit the standards of the lender, then again, collateral is going to be an issue for communities of color. Go ahead, Lamont.
Yeah, one of the statistics is that Blacks are currently being denied at a rate of 2 times the rate of whites, and Hispanics being denied at 1.5 times the rate of white borrowers. So that's an issue that doesn't speak to equity or parity more so. And so this is another reason why we monitor this, so that we can get those indicators looking a little bit better.
Mm-hmm.
Yeah, and as we discussed in our last webinar back in October, I just lost my train of thought. Oh, the primary reason for denials, especially to people of color, but also for other groups, was credit. And then the secondary, the second largest reason for denial was this collateral issue. So these are definitely 2 things that we need to take hard looks at.
Right. And, I think the slide, we just sort of have a few bullet points that the blog gets to, but there's like all these interlocking issues, right? When you think of redlining and how different parts of a community were categorized, and then who lived in what neighborhoods, and if they were in the red areas, a lot of these were located, let's say, near industrial sites. And so decades later, those properties were valued less. Not to mention all of the health issues and environmental health implications of that, but all of these sort of work together to really make this a tangled knot, if you will. And then over generations, right? So being denied access to credit over the years means that these families aren't able to build wealth over time, and that means then subsequent generations don't have the ability to access down payment resources or funds for home repairs and maintain those properties. So these 3 C's, if you will, I think are a really great way to think about all of these issues. And sort of then you can kind of start thinking about, well, what do we do about the first C or the second C or the third C? Okay, so we're going to go through a few slides. If you have joined us the last 2 times, a few of these will look very familiar. We haven't updated these rates just yet. They're still based on the most recent 5-year average of ACS data, mainly because the census data was still released somewhat recently, and we know that they're still kind of working on getting, you know, kind of things together. So I expect that hopefully by our next webinar in 2022, we might have, but also we probably would surmise these may not have changed all that much.
Yeah.
So you see the overall homeownership rate for the city and the county, and then you see the rates by racial demographics. And obviously there's a clear gap between whites, blacks, and Hispanics in terms of the homeownership rate. And this is something that is really, I think, become a huge focus for those of us in the community and economic development sector. I think it's always been there, but it's now become a top strategy and something that a lot of communities across the country are really looking at how they can address. I always include this. It's an older chart from PolicyLink's National Equity Atlas, but it's still a really great source of data, and it's a great visual to give you a sense of that earlier part. We talked about how things really haven't changed since 1960. This shows you 1990. And the more important thing is that it shows that disparity actually increased as a result of the Great Recession. And again, I think that's where you can go back to that framework of the collateral and capacity part of things. When the homeownership market really fell, I mean, that's where we saw our homeowners of color really impacted. I saw Bethany nodding your head, so I think you might have a good insight on that.
Yeah, I would say that, you know, the Great Recession, which is how it's generally referred to, sort of sanitizes it, because in our experience here in Milwaukee and communities across the country, it was the great foreclosure crisis, and that's really what spurred the recession to a large extent. In any case, maybe not exclusively, but it certainly pointed out the ripple effect that home ownership and housing has on the economy. And yeah, it was because of subprime predatory loans that blew up, and then the things started to happen in the economy, and so then people started losing their jobs, and then there were more foreclosures. You know, it wasn't all because of predatory loans, but to a great extent, those were the beginnings.
Right, and I mean, this is where I feel like Maria Prioletta, and I don't know if she wants to jump in, but I remember during that foreclosure partnership initiative, one of the things that the city really looked at was the impact was that a lot of these foreclosures were actually people who had refinanced into loans, these subprime, these more exotic products, because the rates were low, they could lower their payments. They were really targeted for that. And people, and you know, we know that, I mean, if you're getting an offer every day, you'd think you were crazy not to take it. So I mean, I just think that there's a definite impact, and we can look at the data and see that. And so I don't know, Maria, if you did want to say something.
Yeah, no, just to build on both what you and Bethany said. Like Bethany said, the first wave of foreclosures really was concentrated and a result of the subprime crisis. But, you know, the national narrative at that time that we heard a lot was, well, we put all these people in home ownership who really didn't have the ability to do it. That really wasn't the case in Milwaukee. Over half the subprime lending, for example, in the Black Grand area was to existing homeowners.
Mm-hmm.
So in terms of home ownership impacts, it wasn't just people not being able to buy a house as part of the disparity, but long-term homeowners were getting displaced because of subprime lending and the meltdown in the financial industry. So it was, you're exactly right, you guys, it was existing homeowners.
Right.
And home ownership is such a slippery slope. I mean, right, you have to be able to support payments over 30 years. What we know is that Black and brown people generally have less income. A lot of our homeowners that are of color are working low wage service industry jobs, frontline worker jobs. And they also tend to support more extended family, which decreases the discretionary income. So it's very true that some of our roots of the home ownership gap are based on the economics, not just access to being able to own a home, but what's your economic situation? What's your outlook? What kind of credit do you have? So all very good points that my co-hosts have made.
Right. It's worthwhile to think back through that, because obviously where we are now is really a result of what's been happening before us, right? Okay. Median household income. So this actually dovetails off of what Lamont just said. The disparities here are also very stark for the city and the county. And UEDA was working with the city of Milwaukee to put together a HUD consolidated plan over the last couple of years that finished earlier this year. And often when I would be working on all these housing types of framework and questions, I would think back to this very data point that the city has this disparity in household income, and we have a higher poverty rate, and that really impacts people's ability to afford housing. And so you see that both in rental and home ownership issues. And I'm going to ask Bethany to talk about, I included this slide from the webinar we did in October about lending disparity profiles. And this really shows, and this is all applications, but if Bethany wants to talk about, this is where we really get around the denial and access to credit issue a little bit.
Sure. So this is from 2020 and for the city of Milwaukee. So all loans and it addresses all loans and applications in the city in that calendar year. So if you start on the right side, it's the total number of applications. Purchase loans, actually don't even figure into this, but the fallout refers to loans that were applied for initially and then fell out of the loan process. It might be because, excuse me, it might be because the borrower found another lender, or it might be because the borrower got frustrated with the lender that they had applied to. It might be because the lender never received documentation that they needed in order to underwrite the loan. Lots of reasons for fallout, but that's an interesting and helpful category to watch. Denials is exactly that, the number and the percent of denials to each race. And then originations refers to, and you'll hear us talk about originations a lot. So originations are loans that were made to the borrower. It was the original loan that was made to a distinct borrower. And we can see that, despite Milwaukee being a majority minority city, that's not how the loan applications or denial, originations or apps or denials play out. We have a lot of work to do, and you can look at the numbers for yourself. And I'm not sure, but I think Christy said at the top of the meeting, but I'll say it again. Yes, we will be providing these copies of the slides, so you can look at all of this later.
Yes, I was just saying I can include a link to the October 8th slides so people can see how we got into that. Okay, Ned has a question. If there's any type of information about the number of applications that should not have been denied but were denied.
That's really hard to say. I mean, no, is that not public information? It's yeah. That's all within each institution, and typically each lender will undergo a fair lending evaluation, and if the regulator that regulates them sees a pattern in a practice, they may dig deeper. But in terms of public information, there's not a way for us to determine which loans should have been made but weren't.
Right. There is data though on the reasons for denial. So that's in those slides. So you can see by race to the reasons, but I don't think I put it on the slide, but it is credit is the top. That was what was demonstrated. And there were a couple, the other one was related to, I think, the loan to value. So that gets at that collateral issue.
Yeah.
So you can look at it in different ways, but like as Bethany indicated, it's hard to know why someone checked the box, right?
Right.
The no box. Okay. So getting to our discussion slide. So, as we think about this information, like we really think about how do we decrease this homeownership disparity gap? And so in our city, that gap for Blacks and whites is 28.5 points. And for Hispanic, Latinos, and whites is 18.7. So that's a lot. When we look at some of the loans and percentage increase in loans and who gets loans, it actually looks like we're making some progress. Speaks a lot to the very active lending and homeownership market right now. But, obviously that's a lot of ground to make up. And then we sort of think about what can we do to address these disparities in terms of credit collateral capacity, because that ultimately is what gets to that gap. How are people able to buy a home, keep their home? And then one of the things we talked a lot about at the last webinar was decreasing this number of fallouts and increasing the number of originations for non-white borrowers. So getting to yes. So how can we help someone get to the yes box versus the no track? So I don't know if anybody, Lamont or Bethany, if you want to add anything.
Well, just to that point, we also sent out after the event a handout with a number of suggestions for lenders for how they can work within their own institutions, and then with borrower, applicants and potential applicants, to increase the number of applicants, and then to make sure that people don't fall out of the process, that they're fairly evaluated, and that if they need a little bit of hand holding, that hopefully they'll connect with the borrower, that the lender will connect with the borrower, but also that the lender has loan officers that have an understanding of the community that they're serving, including the Black and African Americans and Latinos, and that they are, that they can speak the language literally and figuratively, that they, have a understanding for what kinds of barriers might come up and help them to work through it.
Yeah, and we'll talk about some of that later at the end of the webinar, and we will also send that handout again. I don't think it's bad for us to keep sending that out.
No, I think we should, for sure.
I want to add that education is a great equalizer. Home buying, counseling, education through Bank On, another great initiative to get people ready for savings. Because sometimes what you find is that people think they can't afford a home, but they don't know because they haven't even started the process. So getting them to a home buying counseling agency to talk about what it looks like, them working with banking to get their finances together. And also, we cannot ignore that we need to do more to make sure there's wage parity. Women are traditionally underpaid, and a large percentage of people of color households are women-led, where women traditionally earn less than men. So we have some things that go way beyond what we're doing in our housing world that is impacting this number. But it's important to note that we need to do more on many fronts, and not just getting people to the table to sign the loan documents, but all those things that impact them before they can even consider applying for a loan.
Right. I mean, Lamont, I'm pretty sure Constance, I think from UEDA, our Bank On program manager, is on, and she probably just cheered to hear you say all of that as well.
Yeah, absolutely. Actually, I'm really glad you raised that point too, Lamont. And one thing I just want to interject really quickly is that HMDA data also can show the sex, the gender of the people that are making these applications and being denied and or having an origination. So that's maybe something for a subsequent webinar.
We looked at, and we talked about also even age. But we could, we did race on the lending disparities. We could look at gender and see what that looks like. Okay, so now we're going to move to the next part, which was the lending data. So this is going to be a lot, but it's interesting, I think, and super informative. And it's actually a great way for us to talk about some of the really great lenders in our community that actually do this work. And so we know who they are, but it's always exciting to see some of these groups move to the top as they increase their loan production. So this first slide is all originations in the city of Milwaukee. And so we do a 3-year comparison to see how this is changing over, time a little bit. And so you can get a sense of kind of what kinds of loans, so purchase, refinance, cash out refi, home improvement, and then loans to, we also look at non-white borrowers and then low to moderate income borrowers. These are owner occupied loans only. So this kind of gets to the filtering that Bethany is able to do in these reports. And then just to note, in 2018 is when they actually started separating out people who did just a regular refinance versus one where they got some cash out. And so you'll see that mainly, the loan production is really increasing. And so I'm going to go to the next slide, which has key takeaways, which breaks down some of these numbers. So there's been a 33% increase in all loans from 2019 to 2020. And this actually means 5,000 more loans. And from 2018 to 20, it's 44%. So that's actually quite huge. And I think last year when we were doing our 2019 data, we were talking about, wow, I'm sure the 2020 data is going to show, again, a huge increase. This is primarily driven, though, by an increase in refinance loans. And so when you look back at that slide, it was a 64%. The bulk of that 5,000 loans that we saw from year to year were refinance loans. Interestingly, cash out was not, I would say, a huge percentage, but it did mean that people were largely taking advantage of very low interest rates to decrease their housing costs. And so that is something that's also has an interesting framework for homeowners of color and thinking about Freddie Mac released earlier, I think I've talked about this a billion times, a toolkit about who actually takes advantage of refinancing to lower housing costs and build wealth. And so, when you think about the refinance activity, this is something that we know we could maybe do to support wealth building for current homeowners. Home improvement lending actually decreased by 3%, which isn't huge, but kind of interesting. But loans to non-white borrowers increased significantly. And so the previous year's increase was about 16% year to year, which was good and kind of kept pace, if you will. But, this from 19 to 20, it was 28%. That's almost doubled. And so that was very heartening to see just in terms of a trend. It's not necessarily keeping pace with the increase in all loans per se, but it is actually it's close. And then for low to moderate income borrowers also increased by 24%, and that was higher than the previous year's increase too. I think what was positive for me when I was crunching these numbers is I thought, oh, the actual increase of loans to non-white borrowers is greater than the one to low to moderate income borrowers. Usually it's the opposite. So I felt like that was a really good sign in terms of racial equity and the kind of work that we do. And so I don't know if Bethany or Lamont or any of our other work group members want to comment on the trends part of things.
I would say that everything you said, of course, is correct. And I think that the home improvement lending, while it's disappointing that it decreased and it was the only one that, only category that decreased in the raw number of loans, that we're talking about the city of Milwaukee, and it only decreased by 26 loans. So it's not, I don't think it's in some ways just statistically sigtigant, and
no.
maybe our statistics people can tell us that, but it's compared to the others, it's not as big of a deal as it might sound. Although we certainly, it's a huge need, and so we certainly need to continue and increase our focus on increasing that kind of lending. But just wanted to point that out.
Right.
Just a footnote, and that is that we still have an appraisal issue, which affects the ability for people of color to do cash out refinancing and home improvement. Traditionally, those houses are undervalued. And so we still have much work to do on making sure that homes in urban areas are valued with the respect that they should be given.
Right. I would say if I think back over the last few years, there's just so much more focus on both the racial disparities in homeownership rates and then this appraisal issue and values. Like, I feel like in this sector, that is just two things that people keep really trying to think about. What can we be doing better? So our key takeaways really, when you just think overall big picture trends, mortgage lending continues to increase in volume. And so this is a reflection of low interest rates and a strong market. And I think there's a lot we can capture and sort of take advantage of in that space, but it's also something for us to keep an eye on. I will say, Bethany, I think I remembered I didn't even ask for the HEPA numbers or reports, that was like the one kind of loan that would maybe indicate a subprime activity. The thing to note after the last crisis was that a lot of those products sort of went away, if you will, like they're just not allowed anymore. We're not really seeing a lot of them come back, but it's something that we should always be mindful of. Like, what is going on with the loan activity that might indicate that, there might be some predatory practices or those kinds of things. Because we just, with all this volume, we don't want to lose sight of the fact that, similar to what Maria Prioletta described, like, could we be in a similar situation again with people then losing the gains that they have made? And then the other big takeaway is that loans to non-white borrowers just really increased significantly. Could this be a sign that we are making up ground? It's not necessarily keeping pace with the overall increase, but it is very positive news. And we'll see that a little bit later as we get closer to seeing who's lending and some of their volume.
I'd like to point out that I think that in addition to the awareness of inequity and the racial homeownership gap, especially in the last couple of years, we've got Take Root Milwaukee that has been steadily, as you pointed out earlier, Christy, the Take Root Milwaukee lenders have been doing a better job in general than their non-Take Root Milwaukee bank participants. And also, so there's Take Root Milwaukee, there's the CRA coalition that's been shedding more light on banks' activity and lack of activity in communities of color and low and moderate income neighborhoods. And then there's the enforcement side. In 2016, one of our prominent local lenders settled a redlining case, and my guess is, I hope is, and I'm pretty sure that the other lenders took a look at that and were like, oh, well, we don't want to have to do something like that. We better pay more attention to this issue and work to more fully serve the communities that we say we serve.
So now we have a whole bunch of slides that actually get into the who's lending, who's the top 10 and what kind of loans are they making. Last year we did a comparison to the county, and I will just note, I forgot to mention. And so when our group talked about it, we were like, there was a lot of similarities. So we were like, we don't know if it's that much helpful to look at. So we're going to focus on the city for this webinar, but then it allowed me to think about, oh, well, I can at least show the differences between last year and this, or 19 and 20, because while some of the lists look the same as we go along, you'll see there are some variances from 2019 to 2020 into the who. So it's sort of interesting. And then one of the things we do, I have a spreadsheet that has actually the top 30 that you can access. We will send out a link as an Excel sheet. So you can sort it by these different categories and see, who in the top 30. Home improvement is where it gets really weird in a way. Like, there's just a lot of lenders we don't normally see. We'll talk about that. So as you see here, all loans. So this is purchase, refi, cash out, refi. Our top 3 lenders continue to be the credit unions, with a little bit of flipping going on, but and then we've got a number of our Take Root lenders. That's the star. So some of our banks who have been super active. And then we see Quicken Loans move up a little, a new mortgage company. Well, they're not new to this list, but they increased their production, I would say. And then Johnson Bank actually moved into the top 10. When I did the Take Root lender comparison, I can see the actual loans for the Take Root lenders. And I think Johnson Bank and Associated, I have to look when maybe we get later, they actually increased just the volume of their loans by quite a bit. And I see Paula asked about cash purchases. No, you do not see that in this data. And that is something we talked about at the last webinar as well. And that comes up on a later slide, is that is one thing in our market that we know is happening, but we don't have a really great way to capture that short of once you see who's buying it. So you'll see here the differences. Then we break it out for 2020 by loan purpose. So you can see, and this also is fairly interesting because again, the list looks kind of similar, but there are some changes. Who was the top in refinance, cash out, refi, home improvement. And this year I noticed that Associated Bank moved ahead of Landmark Credit Union. So Landmark has been the #1 lender in all categories for a number of years. And so again, this is why it's kind of interesting to parse the data out in these different ways. For us at Take Root, it's a way for us to champion the lenders we work with. It's also a way to say, we need to get some of these credit unions involved in Take Root. And so that was one thing that Joanna, I want to give a shout out, her and Constance on our team are really trying to work on in 2021. I feel like we can make some good headway there in getting some of these credit unions involved in Take Root Milwaukee in 2022, which I'm still having a hard time wrapping my head around 2022 being the next year. But so again, you'll see a few more mortgage companies in some of these lists, home improvement as well. It's just sort of interesting. That speaks to probably maybe somebody that somebody knows. They got a loan from there, the equity issues and sort of where can I get the best deal, that kind of a thing. So I don't know if Bethany or Lamont, if you want to say anything about the top 10 in these categories.
Well, I always wonder, Bank of England. So that's England, Arkansas, as it turns out. And they, excuse me, they primarily work in Jacksonville. They're primarily lend in Jacksonville, Florida. So, but somehow they turned up on our top 10 list. Another thing I'll say about the top 10 list more importantly is associated. So this is by loan purpose for home purchase to all borrowers, no matter their race or their income. But I will also say that Associated Bank for the last 3 years in a row now has been #1 in terms of home purchase lending to non-white borrowers. And so I would just want to give credit where credit is due and make a note of that.
Bethany, can I just for a second, I want to say how, because I think there are other partners on the call that can take this intelligence back to their institutions to drive the same change. It's really an intentional investment through our multicultural and affordable lending team led by Melissa Blount and locally by Eduardo Herrera Mayer. They cultivate teams that play the long game with borrowers. They work with them over time to partner with our HUD certified homebuyer educators like ACTS and HRI and UCC. And they are very patient with these borrowers, and they don't take a 5-minute approach to, oh, I'm sorry, you don't qualify today. We'll talk to you some other year. They begin a relationship with that borrower, and they work with them often face-to-face, even during COVID, over a long period of time to cultivate and help them overcome the hurdles they have to qualify for a mortgage. I just really can't overstate how much a purpose-built team makes a difference in this space. And I would venture to guess that is entirely the reason that Associated has grown our market share with purchase transactions and minority home buyers. So thanks. And everybody else can do this too. That's what our secret sauce is. Down payment assistance also helps. Our PATH program is another agent that helps borrowers overcome if one of their hurdles is not having enough money to make the down payment. Our PATH program can help them overcome that. So, it's not a secret. I'm sharing it because I think this is the collaborative space where other lenders can look at what we're doing, and that's what we're doing. It's that intentionality. You've got to have people, not just a call center. You have to have people in the market to substantially serve underserved communities. Thanks.
I remember Bethany leading a CRA discussion when the Associated Bank wanted to grow and expand their market share. And I remember sitting there and watching the bank members stoically listen to the things that we had to say. And I'll be very honest and say that continuing listening never stopped. It's happened throughout the years since that first meeting. And that's another reason why we do what we do. And that's a powerful tool of CRA, and also having the HMDA data and Associated Bank, I guess, with some of our intervention listen. And now here we are. So congratulations, Associated. Bill, you do awesome work. Eduardo, same here. You guys rock, and thank you for being in that space there.
Yeah, Bethany, hi, Melissa Blunt's here. I just wanted to add, yes, we have an amazing team. I'm so proud of our folks and the efforts, as Bill has just pointed out. The one thing I will say is 2020 was, very concerning for all lenders. Would people be able to, in a COVID environment, be able to switch and be able to be more digital? So you had that digital divide, right? So we really rolled up our sleeves and worked hand in hand with our partners to help folks understand what to expect, right? So when you do this online application, okay, so this is how your documents need to be changed into PDFs and things like that. So we're pleasantly surprised at how many folks were able to adapt to the digital experience. And we saw a lot of efficiencies there as well. So I just wanted to add that piece for 2020.
That's great.
Thanks, Melissa.
Eduardo, did you want
Yeah. So one of the things I think that I really have value and what has made a difference in terms of the impact that we have had in the communities has been the honest feedback that we have received from our partners internally and also externally, in the community. The engagement that we have received from the nonprofits, the feedback is reflected in our programs in terms of having a requirement of the home buyer education, kind of what Lamont has said, and we are out there trying to make a difference in the community in terms of the financial education, the first-time home buyer education. We feel that that's a key piece that we have to year to year continue to do. But like I said, we wouldn't be able to do it with our partners, not just in the housing side, but it actually it goes down to some of the neighborhood groups that we have participated with. And so the engagement has been great, and we would like to continue to have that engagement and honest feedback so that we can continue to make the changes and we can continue to make the differences in the communities that we serve. So thank you to everybody.
Well, thank you. I was really glad to hear Melissa talk about that digital divide, because it really, I think, reinforces Bill's comment about having that purpose-built team of people. It's the people to help the person know how to do the PDF or to get their application in. It's a lot of people can do it themselves. A lot of people need a little help. It's a new thing, right? Or they're probably doing the right thing, but they just need someone to almost validate, like, oh yes, you did it. Good, you're good to go. That communication. And I was just looking at Dr. Amaya's comment too. I think, what happens to larger institutions is sometimes you lose people, you transition and you think, do we really need this role? Or, maybe we'll hire that later. I think this really speaks to, you have to be super intentional keeping these teams in place as a larger financial institution, and it will take you very far, right? So again, that intention, but I think it's too easy when you lose a person, a staff or whatever, and think, oh, we can get by for a while. Maybe not, right? You'll see it in your loan numbers probably eventually. I'm going to actually go to the next slide, which just actually sort of summarizes what we just talked about. And I also on this slide list out, there are a number of lenders that show up in your top 30 list for cash out refi and home improvements, but they don't have enough volume to actually put them in the overall top 30. So I usually just list them separately just so we know their names essentially or who they are. And so you see them, and then I listed some of the newer mortgage companies that pop back up in the top 30 as well. Our credit unions continue to have a strong presence. So now we're going to talk about loans to non-white borrowers. And one of the things we did last year that I think was really informative and we continue to do is, so we'll look at the number of loans. So who gave the most number of loans in the top 10 to non-white borrowers, And then we'll look at the share of their lending. So how, like, what is the percentage of all of their loans that go to non-white borrowers and low to moderate income borrowers? And so again, these are all originations, owner occupied. And we have indicated there who's a Take Root member and who's new to the top 30. You see Freedom Mortgage. So this is our top 10 of lenders who have had a number of loans to non-white borrowers. And again, a lot of credit unions, Johnson Bank. Doesn't look too much different from the last year's list. And Bethany, I don't know if you wanted to say something before I go on.
I am not sure what, because this is all loans. Yeah, I was like,
Yeah.
I momentarily forgot. So Associated, when I was talking about how Associated has been at the top of lending to non-white borrowers for the last 3 years, it's for purchase loans.
Yes.
It's originations to purchase loans. So I just wanted to make that clear that I wasn't saying the wrong thing before.
But getting to your point, now the next slide, when you look at share, that is where they have also made ground. So, you know, Marine has a special product. We've talked about this before. That's why they show up in this category. And if they're like, we kind of are aware of it, it helps people with like really specific, I think, is it a loan to value issue? I can't remember, Bethany. But it's like it's an interesting product, but they're pretty intentional about how they use it and transitioning people to a more traditional product. If I remember, right?
I hope so.
Yeah, well, we might want to check in and make sure that's what's happening, as it was like a couple of years ago. But again, then you see the percent. So the share of all their loans that go to non-white borrowers, this is where you see some differences. And this is where it kind of gets interesting. Wintrust, actually, they were one of the other lenders, I think, that increased their activity in 2020 quite a bit from 2019. And then you'll see a couple other mortgage. And then this is where you see, actually, it's interesting, like Landmark isn't in this list, for example, and part of it is because their volume is higher. And so the share percentage, you know, that's where it gets kind of interesting. When you look at it now for low to moderate income borrowers, similarly, you know, so these, again, in the spreadsheet, you can sort these in different ways and get a sense, but again, you'll see some of our credit union partners at the top. There's a little bit of flip-flopping that goes on within these lists, but generally they're kind of the same people. Johnson Bank comes back up into this list too. So you know what, I'm going to actually go to my other notes just to make sure. I was looking at this last night. And I had some other, I know, I was looking at, it's interesting to look at the list and think who has a strong local presence, you know, so out of the top 30, and like 8 of our 10 lenders here, if you listen to the top 10, actually have a pretty strong local presence, even if they're bigger institutions. And, you know, there's some differences. And then I also thought it was interesting, Wisconsin Mortgage Corp, which is, I believe, the mortgage corporation for Shore West, if I'm remembering. Yeah. Yes. They're always in the top 10 for purchases. But this is, I think, one of the first times they've entered the top 10 for LMI borrowers. So, you know, just these weird intricacies that you see, mainly because I'm the one person that's doing this year to year. I'm like, wait, that's a little different from last year. And then when you get to the share, oops, sorry, I don't want my mouse to go. Again, you see a different sorting, if you will. And so, you know, this is all about how successful are lenders actually in reaching more of these borrowers as a share of their overall lending, right? We know there's disparities there, right? For both serving people who are low to moderate income as well as non-white borrowers. And so the share is actually really an interesting place, because these are the lenders that are doing this more as a part of their business. They have that intentionality and they are making ground on that. And so this is where you see the share. The shares end up being where there's less of, I would say, more of a local flavor. And then the credit unions aren't as prominent as well as in these top 10 share of loans lists, mainly because their volume is higher, I think. So when you think of how numbers work, it sort of makes sense. But you also, this is where you see some local lenders who really make some progress.
And also, I would say, just a reminder that that's a share of all home loans, and you know, so purchase loans, refinance loans, and home improvement loans.
Yes, exactly. So, are really this, kind of encapsulating both all of these slides. It's really sort of useful to think about the lenders that reach more borrowers as a share of their overall lending, because like how are they doing it, right? Like what is different about that? And this broadens our thinking around how we can reach, these different groups in a different way and more effectively. Generally, our top 10 lists have a strong overlap with top 10 lists for all loans, but you do see some changes. And then one thing I felt that I saw was that the banks are actually increasing the share of their loans to low to moderate income or non-white borrowers versus the credit unions. So sometimes you want to kind of say, oh, look at all these credit unions in the top 10 list, but when you think of the share, that's where we actually see some of our banks making more progress in a way. So, as their volume is increasing, right, are they still keeping their eye on, are we reaching these targeted groups? So I don't know if Lamont or Bethany, if you want to add anything before we go into the next section.
Well said.
Okay. So now we are going to talk about Take Root Milwaukee member market share. And this is something I know that's always great for our members, lender members, because they can take this back to internal, say, look at this is a result of our partnerships with community-based organizations. The data shows it. So what we do is we actually take the list of member lenders, so the current members of Take Root in that year 2020. We look again at originated loans, owner occupied, and then we look actually now where they are lending. And this is because this is the way we did it the first time when we didn't partnership with NCRCs. So if you want to compare over time, and so it's the number of loans that they make in low to moderate income tracts and the percent made in minority income tract or majority tracts. So where people are living. And this is also the geography of where loans are made is just as important as the who gets the loan. And I think that's a great example too, for those of you who are like data nerds, of what HMDA data can tell you. Like you can look at it by the person, you can look at it by geography, you can get, the Lenders HMDA overview reports, and maybe what I'll do, Bethany, is I can actually include links to those, because that's like your summary report of like all the different kinds of data you could get. And it's, so for those of you that want to start digging into this, this is where Bethany can be your great partner. And there's lots of different ways you can look at this data. So I'm going to write that down before I forget. But you'll see, the highlights are, so the previous slides, you see a lot of those Take Root members, we sort of try to point them out. But we'll also look a little bit more deeper. But in 2020, they originated 20% of loans in LMI tracts in the city and 21% of loans. So out of all the loans in the city that originated, I have to look at my table again. You'll see what I'm talking about. They're slightly less than last year, but then when you think of the volume of loans increased by 44%, it's actually the slight decrease is somewhat minimized. It's kind of interesting. If you could, do you want to have your glass half full or glass half empty, or you're like, the glass is medium, it's still there. So we're going to go next to the next chart. So this is what it looks like. So you'll see all lenders, the total loans that they made, the number of loans that were made in LMI tracts by all lenders, the number of loans, and what that percent. So it's 37% of all loans were made in LMI tracts, 28% of all loans were made in majority minority tracts. And then you total it up. And what you see really is that Take Root lenders are making up about 18% of all lending in the city. And they are originating 40% of their loans in LMI tracts. So they're actually beating the percentage of all lenders, and they're originating 32% of their loans in majority minority tracts, again, higher than what all lenders are doing. And when you go to, I put in the 2019 slide to see, it's somewhat similar. The numbers are a little different, but it's actually, this is where you can look at specific lenders and say, oh, wow. Here are some people who actually, increase the number of their loans by quite a bit. And so the main takeaway of that is that Take Root lenders generally are outperforming all lenders in terms of reaching our geographies. So our parts of the city that are generally underserved because they're majority minority tracts or low to moderate income tracts. And so that's what this slide really says. I mean, that's the main takeaway. This is where it's, a great, the charts are helpful because it makes us think about who are we working with, and like really thinking about what we can do to support what they're doing. And so from 2019 to 20, the share of loans in low to moderate income and minor rate tracts by all lenders decreased by 4%. Again, but you can think about the increase in volume of being 44%. So it meant like generally kind of keeping pace in a way. And that take root lenders continue to originate more of their loans in these areas than all lenders do. So I don't know if Bethany or Lamont, you want to say anything about that?
Just one takeaway would be for me, similar to what Dr. Maya put in the chat, is that one, we need to be reaching out to the other lenders who make up the market and see if we can convert them into take root members. And then two, how can we model the approach that Associated Bank took to increase their presence in the market? And maybe Bill, it's up to you to maybe do a presentation instructing these other lenders on how they should be performing.
Yeah, I'd be happy to help share best practices, short of giving away our trade secrets. But I do want to point out that take root members' productivity that is impressive and outperforming all lenders is also a testament to the presence of the Community Reinvestment Act, because banks are, think about how banks get their money. You deposit it with a bank in your neighborhood. And banks are, because you're sourcing your funds from your neighborhood, we're required to use our funds for lending in your neighborhood. And that is what the CRA makes us do.
Yep.
And that's why you'll see more proactive outreach to low and moderate income communities and minority communities, because it's prescriptive by CRA that we must serve them. That's why you'll see banks outperform credit unions and non-bank lenders in this space much of the time. And historically, there's been a lot of ways that banks are able to get more volume for CRA purposes. And sometimes it's by buying, it used to be, and it's that there is now regulatory change afoot that will probably change this practice. But used to be that non-bank lenders, like a broker, I don't want to like Rocket Mortgage, they're not a bank. If they create a loan, sometimes banks go buy those loans from them if they're originated in the neighborhoods that those banks serve, because it helped them with CRA. And some people use the term shell game, like a bank didn't create the loan, but it now is going to purchase it to get credit for it in CRA. That will happen less based on current regulatory trends, I think. But it's important to just understand that banks are outperforming in large part because they have to. They have to serve their community needs. And that is, take root members are motivated by CRA, whereas non-take root members, they're reluctant to challenge themselves to do more lending in low and moderate income communities because they're not required to from a regulatory perspective. They're getting there from a social responsibility perspective, but they're not required to do the same thing that banks are. Thanks.
Right, and just to add to that, I would say that there certainly has been a move afoot that's gaining some strength to in this environment of revamping the regulations that cover CRA to include all lenders, all home lenders. So to include those mortgage companies and include those credit unions, so that they too can have their, be regulated and have their feet held to the fire in terms of their performance in serving people of color and low and moderate income people. And if you're interested, if you're not already part of the CRA, quick commercial, if you're not already part of the CRA coalition, let me know, and I'd love to include you and help get your voice to advocate for that kind of change.
Thanks, Bethany. I think I just noted too with Bill, like that's a really good point. I think on that summary slide, I want to add a bullet point about the impact of CRA because it's such a great tool. I mean, we talk about this all the time. The HMDA analysis, even having the HMDA data allows us to have really informed conversations with the lenders in our community and talk about what we can do together to make this better. And I was just looking at Irma's comment in the chat to kind of building off of that there are a lot of community-based lending institutions. And so I just want to point out in this list, like Their volume isn't as high, so they don't often show up in these top 10 lists, but our community banks, like your Great Midwest, your PRMX, and they actually also really excel in this area. You just don't maybe see it in the top 10 list because of the volume that they do. But again, it speaks to, those are generally their community-based banks, community-based lending. And so they have that intentionality, that local team that really makes a difference. Okay, so we are moving on. Our recap, what have we learned today? Because we know it's a lot. But, here are some just bullet points. Overall, mortgage lending continues to see these big increases, right? And again, it's largely driven by refinancing. So that's just an interesting thing to think about. As much as we are focused on new homeowners, right? Refinancing, and those loans are really, it's a really great tool for people to capture equity, build some wealth, lower their housing costs, right? So that gets to that economic impact. Our loans to non-white borrowers increased significantly, which was great. I think it would have been really depressing if it had not, given the volume of activity. We've learned out of our top 10 and 30 lists who are the most active lenders in our markets. So, we sort of see the who, and then who has this largest share that goes to these non-white and LMI borrowers that we know are traditionally underserved. We know a lot of them, but there are some that we don't, or we don't have an active relationship with. And so that geography piece is also a consideration. So Lamont and Bethany, if you want to add anything before we.
No.
One thing I would like to add that I've learned is Paula in the chat mentioned about cash buyers and how we can monitor that. So I think that's one of the things that I would most like to see us get a handle on, knowing that out-of-state investors are quietly buying up Milwaukee. That percentage of out-of-state investors has increased from 5% to 15%. And often they're going under the radar because they're paying cash and bypassing a lot of the monitoring system. So Bethany may have some strategies already about that, but I think as the Education and Advocacy Committee, that'll be a thing for next year that we'll really try to figure out how we can get a handle on.
Right. And then also, just to kind of bring this back to where we started, is that, how do we decrease these homeownership disparity gaps, right? What do we do to address the legacy of these disparities in credit and collateral? So like the systems that actually get you to homeownership also have this legacy of systemic racism, where people were locked out of being able to access credit and build wealth. And then the number of fallouts, because those are people who are in the process, want to become homeowners. Like, what's happening, right? Is that a way where we can maybe also gain some ground? So now we're just going to move into a few as we close out. And Paula, that's a great question. Who might be able to help us with that is Amy Turum at Department of City Development, in terms of the ownership transfer that registers with these cash purchases, because I think that's like one of the few ways you could actually track who's getting these properties. So I just want to acknowledge that before I move on. So in the blog, they also had some strategies listed at the end of like, how do we get at these economic and racial disparities, right? I highlighted in green things that I could say for certain we are really doing in the Milwaukee. Like these are things we know, right? We know we have great partners and people who are on the webinar today and in the Take Root Network and in this sector. And so targeted down payment assistance, that is something we know there's a gap in wealth, right? So if we help people with that piece, it goes a long way. Other models such as community land trusts, our Milwaukee Community Land Trust is launching, it's here, right? This is something that people wanted for a long time. Looking at things like price differentials due to credit and how that might impact people's ability. Promoting lending to people of color in partnership with Freddie Mac. We are very fortunate to have the support of Freddie Mac of the Take Root Milwaukee initiative. They have a great active team. This is always something we can continue to lean on and ask for their support in different ways. Their duty to serve plans are similar to like a CRA kind of a thing. You can sort of point to those and say, what are we doing here to advance this? And then these other things that are, I think, part of our work, it's not, but these protections for homeowners who experience home shocks, refinancing, and special purpose credit programs, I think are all things that we probably have, or maybe, but maybe we could do more of that. Maybe we could do it better. So Bethany Lamont, I don't know if you want to add on to anything.
Yeah, I would say back to the duty to serve issue and promoting lending to people of color in partnership with Freddie and Fannie. That duty to serve framework is also now up for discussion and comments, and it's a little bit arcane, but it's really important that Fannie and Freddie have, you know, those standards to meet, and that they're strengthened, because right now even the standards that are there, they're not meeting them very well. And so it's helpful for advocates like people in Take Root Milwaukee and across the country to really pay attention to that and to ensure that that changes.
Yeah. Great point. This is where that national level advocacy, if you're part of, you know, like the National Community Investment Coalition is great network, because it sort of helps you stay in touch. They're kind of looking at those types of issues, because we know there's a lot.
I would say that NCRC is one of the few organizations that's looking at duty to serve.
Yeah, because, you know, who wants to look at duty to serve, right? Like sometimes when I talk about this stuff at home, my husband, I'm like, he must just be utterly bored. What we know works. And so this is actually a repeat slide of what we did on October 8th, and it references that handout. This is actually lifted right from that Bethany talked about earlier, and we will send it out again. But it kind of gets to this, what can we do to ensure that all lenders, not just the CRA people on their staff, are doing everything possible to get potential borrowers to the table. And so that longer game, that building a relationship, you know, if you're not ready now, what can we do to help you? And then this other piece of what do we do to increase loans to non-white borrowers, first-time home buyers, and first-generation home buyers. And so this talks about narrowing the gap, down payment assistance, our home buyer educators, who are not only a great pipeline of potential people, but awesome resources that really ensure successful home ownership. Other community-based organizations that work in this space, the community savvy loan officers, we talked a little bit about that. And then loan products that also fit the needs of people. So I don't know if Bethany, or you want to add anything, or Lamont?
Well, there's a lot of different things. These are some of the main ones. You know, narrow the gap, that's a goal. So set goals and provide performance, you know, bonuses or something. It's something that it's an equity issue, and we really need people to be focused on that.
Yep. Okay, I'm going to go to the next one. And so one of the things, and this has come up a few times, these slides, and the next one too is actually a repeat from October 8th, but it talks to this conversation around cash buyers, but sort of what is affecting our ability to close these gaps. So we talked a lot and within Take Root about consumer mindsets. Like there's just a lot of people who are like, my credit's bad, or, you know, I'd love to be a homeowner, but I don't even know, right? And so that's where these trusted relationships really come into play, like, or having a network, a social network, people in your life that are like, I worked with somebody, you can do it. Like that is really kind of where the rubber meets the road. This culture versus product, this came up on our planning call, and I thought it was a great way to frame it, because you go back to that credit, collateral, and capacity. At the end of the day, the lenders are going to be looking at credit. That is the number one sort of issue, right? But, you know, I think it was Bill who actually pointed this out. He said culture drives the change in how you think about collateral and capacity. So you put in down payment assistance program, or you work with somebody who can, right? You think about your capacity, your ability to affect a borrower's capacity. You work with people over time, you meet them where they are, you have people on your team. Like those are all the things that makes it less of a transaction and more of a relationship. And so that pushes lenders to do better, and our service providers to act as more navigators and coaches. So these are these, you know, the dynamics that are hard to capture in data, but actually really make an impact. And then the other thing we talked about was like, how do we ensure that these new program investments that we're seeing, particularly with the infusion of some of the most significant federal funding in housing and home ownership that we have seen in generations, that are reaching these underserved borrowers, non-white borrowers. We want to close these disparity gaps. And so the city launched a down payment assistance program earlier this year. And, oh, I just noticed a typo. Has great success, and the participation rates for communities of color are very high in this program. In fact, the money is running out and it's being reseeded with ARPA funds, and that's amazing. So the lack of savings, we know, is a huge barrier for people. And so that down payment assistance, that was a motivator. That, like, people who are like, there's no way I can become homeowner, it's just, I can never save enough money. Well, now they don't need to worry about that piece. So it's the other parts that maybe are affecting their credit collateral that gets them there, in partnership with those home buyer educators and lenders and down payment assistance. So I don't know if Bethany, Lamont, or anybody else, if you guys want to add to that, too, even anybody on the call, because I know we have some folks from our home buyer education staff too.
I was just going to let somebody else talk for once.
Well, I can just say that, this information, like, it's more than valuable. And with my new role, I'm pretty sure that this is going to be useful information, to go back to the point of getting, those credit unions to be a part of this, and other lenders who, are not performing as good as our members. So definitely good information, and great to continue to have conversations amongst all the players and people who, may have direct contact with consumers, or, are in the service providing realm of this thing. So looking forward to getting the slides for sure.
Yep. All right, and then this was the other market dynamics. This actually was in our a slide from our last webinar in October, but it's still very relevant because that was only 2 months ago, barely. But Fannie Mae recently announced that they are going to kind of include rental history as a potential into someone's, like, sort of credit considerations. Vantage Score is another credit scoring model that generally has some access and could help increase access. Real estate inventory is still a challenge, so it's pricing out borrowers. Like, this is where you get that lack of starter homes, or just a lot of competition for the inventory that's there. Appraisal practices, cash buyers. We always think our duplexes, we think about this as much as our older housing stock has its own challenges. We also have a lot of duplexes, which are actually an opportunity for people to build wealth through owning those duplexes. And then the green or energy efficient loan programs, that really helps, again, with that older housing stock. So what can we do to make sure that those resources are there? And then our non-CRA regulated lenders that also reach a lot of borrowers, keeping our eye or thinking about how we can sort of get a sense of their activity in the market. So I don't know if Bethany or Lamont, if you want to add anything there.
Well, to the renter, go ahead, Lamont.
Just great point about the duplexes. And I would also add that the FHA allows you to buy up to a 4-unit apartment as a first-time home buyer. But people should really be thinking about the wealth of duplexes in the city and smaller units as a vehicle to building wealth. A lot of times we want our single family home. We want to be able to put everyone in a nice, safe environment. But for some people, I think duplexes have the same feel. I'll use myself for example. I stay in the upper flat of the duplex. My daughter lives downstairs, and so I'm able to help her grow her finances as well as have that same sense of family without having too much space. And I think that was one of the things that came up, is that a lot of times we have a smaller household size, but we have a 3 or 4 bedroom. So people should be looking at what is the right size unit of housing for them.
Yes, I'll echo that. Lamont, we own a duplex that we actually want to convert. It's small, but we've been living in essentially a small apartment for the last number of years, and it's good, but it allowed us to save money and do all those things. And so I think, and I believe that bullet point is on the slide because you brought it up a while ago, Lamont. So, and I'll just also know in the comments, Bill said Freddie Mac is also going to use rental history, which I figured when Fannie Mae announced that they weren't too far behind. So that's great news. Bethany, did you want to add anything?
Well, I'd just like to encourage lenders to take a look at Vantage Score and use them instead of Fair Isaacs, because they have a great track record, as you said, Christy, earlier. Mostly what they show in their data right on their primary website is how their scoring has been predictive for up until now, when the market got opened up to housing and using these alternative credit indicators, that they mostly rated car loans and one other category of loans, but they were very predictive. And now that Congress has actually enabled, legally enabled more than one credit rating agency, which is Fair Isaacs, to be in the market. Take advantage of that and go to VantageScore.com. I sound like a commercial, but I do think that it would be helpful to at least investigate it. And they do use rental history and you do use other credit lines. So that's important.
There could be a lot of potential borrowers that are paying rent every month, but maybe don't have any other credit building things in their history, right? And I know some lenders still often look at rental history too, like as a thing, but this is where it then gets incorporated into someone's credit history, which is actually really important based on where, our financial system works these days, right? So we are near the end and we are on time. I have to say my little outline and timing work pretty well. Every time I do that, I'm like, I don't know. But, our next steps are we will continue to lead this discussion. We are really happy to do that as part of the education advocacy work group. I know as much as I feel like doing this data dive, I'm kind of a nerd that way. I love to kind of get in the weeds and sort of see, but I think it really informs the way that we think about what we end up doing in terms of strategies and actions. So potential topics, please feel free to put in the chat. We talked a little bit about maybe we want to look at gender-based sort of lending and think through that. But one of the things we talked about was we had done a comparison of the county, but we didn't feel like that offered too much difference, but maybe we could look at MSA. And so a lot of lenders use the MSA, or the Metropolitan Statistical Area, as their footprint. And so if we compare the city to the MSA, we might see a lot more difference. And so I think that might be an interesting way for us to do our 2021 HMDA data. And so we can think about that, or we could do it just, for 2020. Generally, the data is released now a little earlier every year by early summer. So Bethany and I are going to really work. I would like to be doing this webinar maybe sometime in the late summer or early September versus December. So I'll try to make that a priority. So if there's anything else you'd like to see, please feel free. And I was just looking at Amy's comment too, the culture of finding new borrowers. Yes, that kind of gets to that mindset too. Like people just, it's one more thing. I'd love to become a homeowner, but how would I ever find the time to do that? Like go to the class, work with the person. And this is where that social network in some ways really becomes critical. I think an old tool for that was like homebuyer clubs, where you have a group of people that your cheerleader, your coach, your person that keeps you accountable and says, we can help you with that thing that seems overwhelming because you have 5 other things to do in your life, right? And so I think that's a really great comment too. And so it also looks like Maria and DCD, we were kind of thinking about those cash buyers. So thank you for that, because that might be something we could also do a follow-up webinar on. Maybe not looking at the data, but what can we learn about the cash buyers in our marketplace? So I will add that as a potential topic.
And just a reminder that I can generate reports that from this lending pattern online platform that we have access to, custom reports for you and your neighborhood. I can look at geography as small as a census tract or a group of census tracts, or any city in the state of Wisconsin, any county in the state of Wisconsin, or the entire state of Wisconsin as a whole, and can look at individual lenders and their activity in serving low and moderate income people or women or people of a certain age. All of these things, it can be as specific or as general as you want. And my assistance with this is always completely free.
Yes,
I'm
great.
assuming that the lenders have their own access to data and something like this. I'm probably not going to be inclined to, I don't know, I'll just leave it at that.
Either way, it's a great resource. You know, that the lending patterns database really makes it easy, that subscription for Bethany to get those reports and think about this. So please reach out. I'm just going to show a little snip. I know it's ridiculously tiny or whatever, but this is the spreadsheet that will send a link out that actually is your top 30. So it compares by total loans. That's how it's sorted. But then you see the number of purchase loans, refi. That's how we get all these lists. And then the Take Root members who their production maybe doesn't get them into that top 30. I just try to cut it off because otherwise it would go on forever. And so we'll send out a link. We also do the county data. So we didn't present it today, but you'll get access to a file that has both of those spreadsheets. And so really we're at the end, right on time. Thank you for joining us today. We are very glad you were able to. We felt like it was a really active discussion in the chat too. So we appreciate it. Oh, I got some future topics from Ben. Thank you. And we will take these under consideration and keep planning. But as always, please feel free to reach out with any questions to Bethany, Lamont, or myself. And then I will also note for Take Root Milwaukee members and folks, we will be posting the program position by the end of the year. So if you know a great person who wants to help run this program, I'm not going to say something sassy about Joanna leaving, but I just did kind of. So
Still here though. I'm still here.
We'll send it out in a Take Root update before the end of the year. So, but thank you. We are glad that you could join us today. So I think that's it. I felt like there was one more thing I was going to